Okay, let's look at how March MixMax went for you. Earlier we had talked about we have expenses and a revenue here on the trial balance. So you should have written out your income statement. We went over that. This is what your income statement should look like. I also suggested go ahead and do the changes in retained earnings. So if you have your beginning retained earnings, from the prior page, we know beginning retained earnings is 15,900. Now the account went down, right, from 15,900 to 14,600. That is before closing. That's before net income was close to it. But what causes retained earnings to go down? So here's your question. Why does retained earnings go down? It goes down because dividends. So we just saw for MixMax must have paid a dividend of $1,500. So we start with 15,900, we add in net income, subtract, not 1,500, that was 1,300, wasn't it? Sorry about that. Change that real quick to 1,300. And anyhow, net those all up together, and you're going to get an ending number of something. Let me take a peek because I've got it over here. 20,600. All right, so we're going to get 20,600, and then that's going to go forward to the balance sheet. So when we go to our balance sheet, we will pull in for the ending balance for retained earnings that 20,600. Now, notice everything else, all of these other ending balances were exactly what's on that trial balance. So everything else, all of these other numbers are exactly the same numbers as on that pre-closing trial balance. The only account that closing entries affects is retained earnings. Now also, notice we're in balance. And had I not used 20,600 here, we would not be in balance. And everything would be off from there on. Okay? Okay, so by now you should have really at least set up this much on your T accounts. So we have our revenue and our expenses. Notice retained earnings factors in that different ending balance, 20,600 instead of the 14,600. And then, your change in cash and all your other accounts. Make sure you add up the debit changes. You should get 16,962. Add up the credit changes, starting with this 4,700. You should get 16,962. So, if those don't equal, you're going to be off later on in this particular problem. Okay, so we'll just kind of, work through this. It's very much now, from here on out, it's very much like you did in February. So we have sales, 40,000. Sales revenue increases accounts receivable. So we have a debit to accounts receivable, a credit to sales. You don't have to do this at this time, but you can if you want to. We could go ahead and solve for cash collected then. Must have been 33,000. So the crisscrosses equal 33 and 7 equals 40 and 0. And then show the cash collected from customers here in transaction A in my T account for cash for operating activities. So we've got cash coming in from customers, 33,000. Debit cash operating, credit accounts receivable. Then cost of goods sold. Click on it for that to be blue. What's the related balance sheet account? Well, that would be inventory. Inventory goes down when we sell goods. So we have a debit to cost of goods sold, a credit to inventory. Then we can solve for purchases. Since there's no change in inventory, purchases must have been 20,000 as well. When we buy goods, we buy on credit, so accounts payable will go up. So I have a debit to inventory, credit to accounts payable. And now we can solve for a cash payment. Accounts payable went up. That's because the expense exceeded the cash payment. So cash payment must have been $15,000, item B. So we have $15,000 for B, and that would be for merchandise. Just abbreviate that. We have a debit to accounts payable, credit cash. Operating expenses, $83.86, that's for salaries and utilities. We would accrue those items in a payable account. So debit operating expenses, credit accounts payable. Then, just arithmetic wise, we can solve for the cash payment. Must have been $68.99. Right? These two have to equal the $83.86. That's a cash payment for services. So we have a debit to accounts payable services, credit cash. Depreciation expense, the related account on the balance sheet is accumulated depreciation. And then we stop there. There's no cash flow. Rent expense, the related balance sheet account is this prepaid rent. It goes down when we use the rent. And it's in balance, so there were no cash flows. Interest expense, what's the related balance sheet account? It's interest payable. It would have been accrued in this payable account. And then once we know that, we can solve for the cash payment. So I add these two together, and I get $9,839. Item D must have been our cash payment. So $9,839 for D was the cash paid for interest. Debit interest payable, credit cash from operations. And then income tax expense. The related balance sheet account is the payable for income taxes. And once we know that, we can solve for the cash payment. Must have been $4,006. Ready for E here. Okay, so show that as a cash payment, $4,006 for taxes. All right. Then we have one last item on the income statement. That was net income. On the income statement, net income is $6,000. And we arrive at net income by closing out revenue and all the expense accounts. So you just zero those out. Okay, so in red is our closing entry. And now we just look for, and so now we have taken revenue, converted it to cash collected from customers. We've taken all these expenses and converted those to the cash payments for those expenses. So let's take in green, the $33,000 minus all these green payments. You should get a negative $2,744 as cash from operations. So we actually have a negative cash flow on operating activities, okay? Such as the $33,000 minus those four. So there must be some additional financing activities or investing, but again, we don't have any investing yet in this case, so we know it's financing. So we just start working through, looking for accounts that we haven't balanced yet. Current portion of debt would be one of those. Current portion of debt goes down when cash is paid. Let's see, we're ready for F. So let's make that F. It's current portion of long-term debt, so that cash payment is a financing activity. So cash paid for debt, $556. So I have a debit to current portion, credit cash, financing activity, cash paid for debt. Okay, so we just go through, look for any accounts that aren't in balance yet. Here we have one in retained earnings. Retained earnings, we need a $1,300 debit to make that balance. That's for dividends. Any cash flows with stockholders' equity or long-term debt is financing. So we're going to put that $1,300 cash payment and write dividends for it. So we have a debit to retained earnings, credit cash, financing. If you take the negative $2,744 minus the $556 minus the $1,300, we will get this $4,600. And then we're done. Once that reconciles, we're finished with the direct method. Okay? All right. You also were asked to do the indirect method. Let's go through the 5 steps. Step number 1 on the indirect was to start with net income. Net income is the $6,000. Make sure you don't pull the 4,700, but you start with the 6,000. Step number 2 is to remove non-cash. So non-cash on the income statement would be depreciation expense. We never spend cash. We don't write checks for depreciation, so that's the $675. Since expenses are subtracted to arrive at net income, we add it back. So we're going to put that $675 on the plus side of this account. Step number 3 is to remove our non-operating items from net income, but we don't have any gains and losses, so there's no step 3 yet in this case. And then step number 4, we look at the changes in the current assets and current liabilities. Accounts receivable went up. That's a debit. So we'll put it down here as a credit, 7,000. So increase in accounts receivable. Inventory, nothing happened to inventory, so nothing to report. Prepaid rent went down. That's a credit. So I'll put it as a debit. Increase, doing that. Decrease prepaid rent. So decrease prepaid rent, 500. So I have a debit here, that's a credit. Those are long term, so we don't do anything with them. Interest payable went down, that's on the debit side. So put it in this account on the credit side. Decrease interest payable. Accounts payable merchandise went up. That's on the credit side. So put it down here on the debit, 5,000. Increase accounts payable merchandise, 5,000. Debit 5,000, credit 5,000. Accounts payable services also went up. That's a credit. So put the 1487 down here as a debit. Right, increase accounts payable services. Current portion of debt is a current liability, but it's a financing activity, so we don't do anything with it. And lastly, taxes payable went down. That's a debit, so put it over here as a credit. Okay, let's look and see if we balance. 6,000 plus all of those minus these 3 will give us a negative 2,744 for operating activities. And we reconcile. Yay! Nice to know that it works. Okay? If you need more instruction on the indirect, go back to the February MixMax recording because I went through that a lot slower with the indirect. So again, if you're having trouble with this, go back to the February recording and you'll find it'll be more helpful.